All right, welcome everybody. Thank you for coming. We're excited that you could be here today for this wonderful program that we put together. Just to set you up in terms of the schedule, this session is going to run for an hour now. There's going to be 45 minutes moderated discussion followed by Q&A with you guys. You'll be able to ask your questions soon. We really have a wonderful panel. Very, very experienced people here. Bring a world of industry knowledge to the table, and our moderator, who I'll introduce again in a second, is really a powerhouse, and very excited to do this session. We picked this topic because this is one of the very important topics for Amazon sellers. You guys got to have funding in order to be able to fuel the growth of your business, and this is a very important discussion, and we're excited that you could be here to be part of this discussion. After this session is over, immediately at 6 o'clock, when it's over, you just go through the doors. The keynote session for everybody is next door. After the keynote at 7 o'clock, we move to the other side of the building. There'll be dinner and the trade show. So that's the schedule in a nutshell. I'd like to welcome you all. I hope that you're going to enjoy this program. I'll introduce our MC. Our MC tonight is Moshe Melamed. Moshe is the COO of Modway Furniture, which is one of the fast-growing furniture companies in the country. He's really somebody who brings a world of experience. He built the company from the ground up, and he knows everything about what there is to grow an Amazon business and a business, and he's really a wonderful business person. And I'm very thankful to him for agreeing to be the moderator. He brings his knowledge to the table. So without further ado, Moshe.
Thank you. All right, since I was introduced already, we can move right on. We'll go through it, we'll introduce the panel, and then we'll take it straight from there. After we introduce the panel, I'll go through basically the topics we're going to cover. I heard last year that this panel was boring, so we'll try to change it up this year. None of these guys were here last year, nor was I here, so we all get a fresh chance. So we'll just go in order. Dovi, if you could just introduce yourself and what you do.
Hi everyone, my name is Dovi Wiesel. Name of our company is SBA Loan Group. Our company specializes in SBA loans for businesses, for all types of businesses.
Okay, next, Alex.
Hi, Alex Sklar. I'm the head of business development and strategic partnerships for Payability. At Payability, we help e-commerce merchants and marketplace sellers with financing and cash flow solutions.
TJ.
I'm TJ Highland. I head up the partnerships team here at Payoneer, covering the U.S. region. In terms of funding, what we do is we help Amazon and marketplace sellers with a capital advance to basically inject cash into their cash flow.
And Joel.
Yeah, thanks, Moshe, and thanks for the JCON. I'm Joel Weiser from Funding Nexus. What we do is basically similar to the JCON. We help and guide clients to get the funding they need by advising them and get them funded.
Okay, so when Rabbi Wordy asked me to moderate a panel on funding, my first reaction was, what do I know about funding? I'm not in the funding business, never been in the funding business, don't hope to be in the funding business one day. And the question was, what do I have to bring here and what can I do when it comes to funding? Then I started to think about what funding actually means, and I realized funding is just another word for cash. And regardless of what type of business you are, you can't live without it. And the interesting thing I found when it comes to funding is when you don't need it, everybody is there to offer it. You open your mailbox on any given day of the week, there's credit card offers, people are offering you money, lines of credit, your bank's offering you, your mortgage company's offering you, everybody's offering money. However, when it comes time your business actually needs the money, no one's to be seen. There's a Russian joke told that I think really brings out this point. In the days of communism, so they would go periodically and they would test people and make sure that they had the party line. So one day someone comes to a member of the community and he says, "Comrade, we have to ask you a few questions." Okay, what's the first question? "Comrade, if you have 2 houses, what do you do?" "No problem," he says. "One is for me, one goes to Mother Russia." "Comrade, if you have 2 cars, what do you do?" "No problem. One for me, one for Mother Russia." "Comrade, you're doing great. What if you have 2 horses?" "No problem. One for me, one goes to Mother Russia." "Okay, comrade, last question. If you have 2 chickens, what do you do?" He stands there. He's quiet. He's not answering. Says, comrade, 2 chickens, what do you do? He's not answering. He says, comrade, I don't understand. 2 houses, no questions. 2 cars, no questions. 2 horses, no questions. 2 chickens, you have doubts? He turns to him and he says, the difference is I actually have 2 chickens. To give away everything theoretically is great. To give away my actual chickens, that's another story. So I find that funding works the same way. Everybody's in line to offer you funding, and they have the best funding and the most available funding and the most funding. When you actually need it, though, and it actually boils down to them writing you a check and giving you money out of their pocket, that's generally where things seem to change. And sometimes it changes right away, and sometimes they'll give you the money and then money gets pulled and things like that. So I tried to, when we were thinking about how to break up the session and how to provide the most information and what we want everyone to learn, what we came up with is as follows. We want everybody to walk out of this room knowing what are the general types of funding, how to get them, the drawbacks, the pros, what's good about them, what's not good, how long they take to get, how much you can expect to get. This isn't going to make you an expert on funding by any measure. That's why we have experts here. But it will give you enough of an idea that you'll know what's out there and who to go to and when to go. So what I did is I broke it up into subtopics, and we're going to try to go in order. We may reach all of them, we may not. I'm just going to run through the basic topics so you'll know already what's still coming and what if we missed, we'll have to wait for Q&A. So the first topic we'll cover getting paid faster for your orders. So the faster you're growing, probably the larger your receivables are. If you're getting paid net 15, net 7, net 30, net 60, net 90, depending on who you're selling to and how much leverage they have, the more you're selling, the more they're owing you and the less cash you have. So that'll be topic number 1, is how do you get paid faster. Topic number 2, line of credit working capital. This is not necessarily something that shows up as quickly, but it definitely comes up at some point. Topic number 3, trying to borrow against inventory. If you're in an inventory-heavy business, a lot of times you see that no matter how much money you make, all the money is sitting in inventory. Can you borrow against it and free up that cash? Number 4 is to SBA or not to SBA. Most of you probably know that there's something called SBA, Small Business Administration, I think it stands for. And they offer government-backed loans. And there are huge benefits, maybe being able to borrow without putting down a down payment to buy a building, for example. There are also drawbacks and specific requirements that come with it. Topic number 5, I don't know if anyone here is holding there yet, but hopefully you get there eventually, buying a building. You turn around, especially if you're on this side of the coast and you're paying a fortune in rent to somebody else, and you say, maybe I can pay that money to myself. Topic 6, how do you become attractive to a bank? The banks come and they start asking you for documents and reports and things you've never heard of. And what makes you look good to the bank? Part of it is up to people and part of it is up to the numbers. Next topic, when do you take, this is a bit of a bigger topic and we'll try to cover it at least on a basic form. When is it better to borrow money and when is it better to take on equity partners, to give up part of your company? That's a tough question, not a simple, straightforward answer, but we'll see what we can cover. Next topic, got the cash, maybe due to some advice from someone up here. What do you do with the money? The do's and don'ts. Don't spend it all at once, probably. The last one that we'll cover before Q&A, if we get to it, is supply-side financing. I don't know how much that will be applicable to this crowd. If you get large purchase orders and things like that, where you can go ahead with financing. Okay, those are the topics we're going to cover. We'll go through each topic. Whoever has something to say will say it, and we'll move on from there. Topic number 1, getting paid earlier. So some of you probably know that there are funding products, either directly built for Amazon or from Amazon, where you can get paid faster. Some of it is also negotiating. Some of you may not know, or most of you may not know, what are the products, what are the benefits of one product over the other, what's the general cost of use, money doesn't come for free, what's the value of getting paid faster, and what are the costs that come with it. I'll open up with the panel. I don't know who wants to take that one first.
I'll jump in. So when we're talking about getting paid faster from Amazon, I think it's first most important to remember that if you've been selling on Amazon for over 10 years, you probably have an option to get paid every 3 days if you're grandfathered in. For the rest of us, you're getting paid every 14 days. Amazon has created a feature where you can get paid every day if you press a button, but the downside to that is you're basically resetting your 14-day window of when you're going to get paid, and all you're receiving is your actual unavailable balance at the time. So you're receiving a small portion of what you get paid. Then there are companies that are designed specifically to pay you faster. There's only a couple of them out there, and what they do is they essentially take old-fashioned factoring and put a digital spin on it. So one example would be if you're on Amazon, you're getting paid every 14 days. You could get up to 90% of today's sales advanced to you tomorrow. And then in 14 days, when Amazon makes the full payment available, they'd send you back the remaining 10% minus a small fee. The trick with factoring in these type of products is there's really only a couple companies that do it, because you're taking what was traditionally a consumer invoice and making it a factorable invoice. If you're selling on the vendor side, or you're selling on different marketplaces where you have distinct invoices because it's B2B, then you could go to more traditional factoring companies. But you should know you'd probably have to be doing at least 10 to 20 million a year in revenue before the companies would be able to work with you. And that's mainly just because they haven't really caught on to the way e-commerce works. And a lot of them still think it's kind of a fad. So there are a couple companies that specialize in this. Our company is one of them. And rates typically between all the different companies for the largest and most established sellers can be as low as like 0.3%. And then depending if you're international or not, it can be as high as 3%. One thing to note about the rates is you have to think about the rates as kind of a line item in your fees. So you'd have your FBA fees, you'd have COGS, and then you'd have all these different line items. You'd have one more line item that would essentially be getting paid faster. As it's not a true loan product, there isn't an APR component. So if it makes sense in your business model and your margins are set that way, you think about it as one additional line item. Does it make sense to get paid faster? Because the goal with getting paid faster is being able to buy more inventory, turn your inventory faster, reinvest back into business, and essentially scale your business faster than you would getting paid every 2 weeks.
So before we move on to the next one, Alex, if you can just give an example. For example, and it's not always like you always have to take your money faster. You have a bunch of product coming in tomorrow and you need cash. And you have $100,000 sitting in Amazon Seller Central. It's showing there at the top your current receivable balance, $100,000. You want to pull out that $90,000 tomorrow on a one-time. What's that going to cost you on average?
So typically companies don't usually work on a one-time, but some of the companies are creating like a flexible product where you could turn it on or off. So if you're going to come in one time and turn it on, it would depend on how long you've been selling and what size business you are. So if you're a $100 million a year business and you've been selling for over 5 years, that'll probably cost you somewhere around 0.3 to 0.4%. If you're a company doing about $50,000 a month and you've been on the site for about 2-3 years, it's probably going to be closer to 1.5%. And then you have to pay attention to whether or not that fee is on the gross or on the net. Some say that they'll only charge you, let's say like 2% on the net versus another one that charges 1% on the gross. So that's where you need to see your own spread of costs to see what your spread is between the gross and the net to know if it makes sense for you.
Okay, I mean, keep in mind that 0.3 doesn't sound like much, but just realize how much earlier you're getting it. And then multiply that to 12 months and you get what the annual interest rate would be equivalent to. TJ?
No, I think Alex really covered it pretty thoroughly.
Joel?
I would like to add some of the advanced products out there that people are familiar, like Amazon Capital, and similar like advanced, not even getting paid for whatever Amazon owes you already. Some of the companies will give you money against your future receivables, future sales. Now, this seems like a dream to get paid even before you even sold anything. But keep in mind, most of these, and even Amazon Capital, the term for that is pretty small. It's 6 to 12 months. So even though set aside about not even thinking about the interest rate might be something acceptable, but you have to think about your monthly obligations, how much your principal payments you're going to pay every month. And sometimes you get like $100,000, or I had a client that got $1 million from Amazon, but that left them with $200,000 monthly obligation. And what ends up happening, it takes a few months, that money you got from Amazon to make that into new business, it takes a few months, and you starting already paying against the principal payments. That's another thing to take accountability.
Any of you know anything about C2FO? I know that they've been pretty aggressive, at least on the vendor side.
Yeah, I know a fair amount about C2FO. It's a company we work with. It's a factoring type product again, and they typically work with larger established brands, and what they're doing is they're essentially creating a marketplace for invoice factoring. So instead of going to a lender and being offered one rate, Toyota can essentially go to Mitsubishi and say, I'll give I'm willing to pay you, if you're willing to take a 3% discount, I'm willing to pay your invoice off fully. So what they're really trying to do there is create a marketplace of who's willing to take on others' invoices at a discount instead of having to go to each individual lender, which I think over the next couple of years we'll see grow a lot more because it's taking that marketplace approach, which should create speed and liquidity.
Okay, I mean, one thing I've seen personally with C2FO is you can do it on a case-by-case basis. They'll send you these emails. They're linked directly into Amazon, so they'll send you these emails that say, this is the amount of money we could get you tomorrow if you're interested, and then you go and you kind of bid for it. So you give in how much you're willing to pay for that money, and either they'll accept it or reject it, though I think there are some minimums there. Okay, anyone else? Dovi, you want to chime in? Or?
This is not something
This is not
related to SBA.
Okay, not yet. Well, it is, but we'll get to it. Okay, next topic, line of credit working capital. I myself have had the experience where you have a small line of credit with a bank and everything's great, and then you go to them and say, it's too small, we want you to make it bigger, instead of coming back with great. Well, first they tell you, yeah, it looks like it can work. They drag it out for a couple weeks. We're almost there. We just need one more approval. And then they finally come back and then they say, well, it went to underwriting and they decided that your risk profile doesn't match the type of businesses we're looking for, and they pull your line of credit and give you 30 days to pay it back. So, been there, done that. Having said that, there are benefits to a line of credit. One is you have the money there for a rainy day even if you're not using it. You never know when you're going to need it. And the second one is you can draw and then pay it back depending on if you have spikes. If before Chinese New Year, if you're importing, you get a lot of inventory. Before the holiday season, things like that, you can draw out and then pay it back and not pay for that money while you're not using it. Okay, who wants to start with that one?
I will. So, I mean, there's a pretty big difference between, or at least in my eyes, between a line of credit and working capital. I think if you think of working capital as a product, that's separate. But if we talk about working capital, a conversation we all had was about where the best place to get it is. The line of credit. In our experience, the best place to get it is still from those larger banks that you work with. The national banks versus the more community banks. We see that the pricing is generally better, but the real issue that you're going to have is that they don't really understand your business, and that kind of circles back to the level of trust and them understanding what you're really doing. In terms of a working capital product exclusive of a bank, there are many or a few and growing number of companies that will offer something like that. And in this industry, why that is crucial is because those working capital offers are being underwritten based on your sales and your payouts from Amazon. So these companies have created these products that are built specifically for Amazon or marketplace sellers, so they understand the industry, they understand the ebbs and the flows, they understand how Amazon works. They know that they're taking a risk because there's obviously always the potential that you could get shut down on Amazon, but that might be built into the price. Whereas the bank, if you get shut down, you're still going to have to pay, and you're still going to have to pay any working capital, but they're probably more willing to be a little more flexible in how that works.
Joe?
Yeah, I would like to add another part to what TJ said. I typically would start with the question, how much money you really need. So sometimes if it's just a few $100,000, it doesn't really pay to go through the full underwriting. You could get from unsecured lines like a few $150,000, $200,000. And if that could cover with whatever you're doing right now, I wouldn't say you should try to rock the boat. And I've seen that in the past. A lot of clients are like dreaming of that line of credit from a bank, $500 to $1 million. It's not so easy to get it if you don't need it. Now, about when you outgrew that part, you need to get a regular line of credit. So the number one thing I would say is you have to make sure you're going to a bank that understands the Amazon model, and not only they understand it, they did it. Numerous times I sat with clients and they were telling me, I have a banker in Bank of America sitting 20, 30 years with him, and he promised me they're going to give me whatever X amount of money. And I told him, listen, it's not up to your banker. It's the underwriter that makes the decision. And from my experience, this type of business is never going to pass Bank of America. I just give an example, but specific industry, it wasn't, Bank of America would never do it. So the number one thing is when you choose a bank, number one, make sure they understand the Amazon model and they do it. The second major thing that I see a lot of people making a mistake about what a line of credit is all about. Typical line of credit is made for short-term capital needs. It's made like if someone has a lot of seasonal expenses, like I had a company that did a lot of holiday sales. So they had like 40–50% of their sales were concentrated in December, in that time of the year. So they needed a line of credit just for short term. That's why a line of credit is made. Why so many Amazon sellers have a problem that their line is being called is because when they got the line, it was in the conditions that it has to be cycled down. And since Amazon sellers always need money to fund their inventory, most people don't cycle down, and it's just not made for this. So the solution for that is besides having a line of credit, should have some sort of term loan. Take some of your permanent working capital needs, term it out, or try to get some other solutions besides a line of credit. There's something called an ABL. You're probably familiar. ABL is more made for long-term needs, but a line of credit typically is made for short-term needs. So if you don't use it, you're not planning to pay it down occasionally, you have to find something else.
One part I would add to the line of credit and working capital point is you need to understand what you look like to a bank as well. And I know we're going to get into that in a minute, but lines of credit with banks are typically heavily FICO dependent. They also want to see if you have personal assets oftentimes, as well as an established business. Whereas some of the working capital products that TJ was talking about, a lot of times because they're basing it off of your sales and they're basing it off of your projected future sales, a lot of those lenders don't have any type of FICO requirement at all, as well as, you don't always want to go down this road, but some people have checkered pasts, previous arrests, things like that. Banks do take that into consideration, whereas some of the working capital lenders, they're kind of built to take on that risk, so they don't focus on it as much.
I mean, the one other thing I would say is I've definitely heard recently of people getting Amazon lines specifically pulled, tight margin businesses. Banks generally get more nervous about those faster. The other thing I would say is there may be some value to having a small line of credit, even if you're not using it much, just to get it started. So you're building a relationship with the bank. You have some history there. And you can try to grow it over time, so when you need it, you're not suddenly going from zero and asking them for $1 million. Okay, Dovi?
I would just add to what Joel said and Alex that one of the things SBA is, where it comes to the picture when someone has a line of credit and the bank pulls it, that's where SBA comes in, that we could refinance these loans, and the SBA loan is a term loan that you pay back every month, interest and principal. So that's one of the things we do when it comes to businesses that have a problem with their line of credit.
Okay, let's move on to the next topic. The next topic is borrowing against inventory. Every Amazon business that I've ever seen never has enough cash, and all the cash is sitting in inventory. They barely have food to put food. They're barely putting food on the table, but on their income, on their tax return, or depending on who your accountant is, they're making a ton of money, but there's no cash to go around. And the reason is that money is always tied up in inventory. So a topic for another time is you should be looking at your inventory and seeing if you're tying it up properly. Sometimes it's better to sell at a loss to get rid of inventory that's sitting and free up that cash for other business. But leaving that aside, there are periods and there are ways to borrow against inventory, not 100%, lower percents, and that will free you up and make it easier to buy more inventory. All right, who's going first on that one? Joel? Go ahead.
Okay, so basically what we're talking about now is to use your inventory as collateral. So the problem with this is that even with a bank, when you have the inventory in your possession, the most you would probably get from a bank is 50% from the inventory cost value. Okay, and even for the inventory that they give you for your cost value, it's only what's in your possession. Most banks won't count the inventory that's in FBA or what's en route or in production. It's only whatever it's in your possession because they have to be able to access it if God forbid you're in default, they count it as collateral, even though you never saw a flatbed coming pick up any inventory. But that's in the essence, this is the way underwriting works. Now, that means that in any Amazon company, you'll always at least 50% cash deficient, right? Because the bank will never give you more than 50%. Now, what I am seeing when I'm working with a lot of Amazon sellers is the only way to cover that gap really is either by getting terms from your suppliers, which most of the times if you buy in China, it's very hard to get. And even if you do get some terms, typically it's not enough to cover till that the merchandise gets sold. The second thing is try to leave retained earnings. Don't take out every penny that the company earns. Let's see that time and again. People are making a lot of money. Look at the tax return. The accountant told at the end of the year, you made this year $300,000-$400,000. Understand that money is not a liquid. That money is tied up in inventory. Leave it in the company. The third thing is try to get some add-on product. When you have a line of credit, there are some add-on products you can get on top of a line of credit. Either it's an SBA loan on top of the line of credit, which will cover you of the part you don't have collateral. Either try to get, there's a thing called, I know people are not familiar with that, it's called supply chain financing, some unsecured products on top of your line of credit. So your line of credit will cover you for the first 50%, and then you'll take some of the add-on products to cover you for the rest.
Anyone else on that one?
Yeah, I think Joel covered it really well. One thing to kind of remember when we're talking about inventory financing, because we all kind of think about it, well, why wouldn't they lend more against inventory? And what we need to understand is if you're buying equipment, that's something you're going to use over a course of many years. When you're buying inventory, you're literally buying something that it may be perishable, it may have a short shelf life, you may not have the warehouse or the area that a lender may feel comfortable that it's not going to be destroyed. There are natural disaster events that can affect the inventory. Plus, it's something that you're aiming to get off your shelves, not hold on to. And those type of calculations really go into lenders' minds because inventory lending used to be really popular about 15, 20 years ago, and a lot of lenders took hits because of different storms and different, mishaps that, the problem we have with lending, and we'll probably hear this conversation as we bring up more points, is you're not always evaluated on you. A lot of times you're evaluated on the people that came before you to that lender and what their previous experiences were like.
Okay, I mean, two other things to keep in mind. First of all, they will generally require your landlord to sign a document saying that even if you didn't pay your rent, if the bank wants to come in and take your inventory, they get first dibs on doing so, since they're always worried about it. The other thing is banks typically will not lend against inventory that's older than 12 months.
Right.
And they can go even less than that. But the bottom line is the bank is looking at it and saying, worst case scenario, you go out of business, there's no money left, what can they actually sell the inventory for? So they're looking at what they can sell it for, how easy it is to sell it, and dead inventory that you can't even figure out how to sell, it's not going to be any easier for them.
Another part, if I may add, another point is, and I see a lot of times, to have proper inventory reporting. So a lot of times when a bank will use your inventory as collateral, they'll ask for detailed inventory count, what's in your possession, what's in FBA. They'll also sometimes ask for inventory aging, and that's not something you could generate out there. You have to have the proper reporting on your end to be able to provide it, and they ask for it.
And if you get big enough, they'll probably come in once a year or send in an outside accounting firm once a year to actually audit. So they'll come in, they'll pick a handful of SKUs, they'll say, you're writing that there's 200 pieces here, where are they? And then they'll walk around the warehouse with you, checking what you tell them and seeing if the numbers add up. And if you have a little bit of a discrepancy, you're usually okay. But if it gets too big, that gets them nervous, and nervous banks are generally not a good sign for anything. Okay, moving on to SBA or not to SBA. Dovi's been waiting quietly, so we're going to finally give him this one. My personal experience has been SBA can be a godsend. First of all, you can borrow money not through a line of credit, but through a term loan. You don't have to worry about it getting pulled. It's not getting pulled as long as you make your payments. Those are some of the upsides. It can help you buy a building with a lower risk to the bank, so it's easier for them. However, there are limitations, including personal collateral rules, which you may not love, the idea of your own house sitting on the line there. Having said that, there are huge benefits, and there are some extra costs and other details that come with it. So, Dovi.
Okay, so I'm going to start first. What is an SBA loan? People look at an SBA loan as the SBA is lending money to the company, but theoretically, an SBA loan is a government program that gives a guarantee to a bank that lends money to the company. So the bank is the one who lends the money to the company, and the SBA gives a guarantee to the bank. And therefore, the bank has more leverage of wanting to give the loan because they have technically between a 50 and a 90% guarantee if any time the loan goes into default. What could you do with an SBA loan? So there are a lot of types of SBA loans out there, like disaster loans, actually lines of credits. Our lines of credits are backed by SBA, but the SBA loans we do are generally for three things. Number one is a term loan for anything related to business. Should it be working capital, inventory, refinancing debt, buying out a partner? So let's say you have an Amazon loan for $1 million that you're basically paying it back over 12 months, the average Amazon term, and the interest rate is around 16%. The same loan on an SBA loan would be a 10-year term with an average interest rate of 7.5%. The second thing you could do with an SBA loan is actually buying a building for your business. So, as Moshe said in the beginning, instead of paying rent for someone, for a landlord, you can technically buy a building for your business with literally as 10% down, and there's actually an option of buying a building with 100% financing plus. So you can actually buy a building for $1 million and walk away by the table with $1.5 million, and the extra $500,000 would be for working capital for your business. The third thing you can do with an SBA loan is buy a business, buy out your partner, or buy a competitor. How that usually works is the SBA would give 90% of the project. So the same scenario I said with the building, you can buy out your partner for $1 million. You can buy a competitor for $1 million and actually go for a $1.5 million loan, but you have to put in 10% of cash injection into the project. So we'll talk a little bit about the qualifications of an SBA loan versus other loans. And generally, there are three criteria to qualify for an SBA loan. Number one is, almost every lender wants to see that, is credit. You have to have decent credit, meaning no tax lien judgments, collections, no prior bankruptcies, no criminal history, and a credit score of around 700. The second thing is cash flow. The bank and the SBA wants to see one thing: how are you going to pay back the loan? So let's just say the loan payments are going to be $100,000 a year. You're borrowing from the bank about $1 million, so your payments are $100,000 a year. The bank wants to see a 1.25 debt service coverage ratio towards the payment. So if the payments are $100,000 a year, the bank wants to see $125,000 of cash flow. That means the company earns $125,000 a year to pay back this $100,000 loan. Two things we need to add when we're talking about cash flow is, number one, we have to make sure the owner covers all his personal expenses and the business still has the $125,000 of cash flow to pay back the new loan. So let's just say that the cost of living for the owner is $50,000. He either has to have that $50,000 from a W-2 income or from outside income, and the company still has $125,000 of cash flow. The second thing we have to take in consideration when we're talking about cash flow if the company has any other loans, let's just say an Amazon loan, a line of credit, or any type of loan, we have to make sure the business can pay back the existing loan plus the new SBA loan. The third thing is collateral. Now, collateral means personal property. If the owner owns any property, there are times that the SBA requires the bank to put up a mortgage on any property to secure the loan. So that's actually a little bit tricky. I'll talk a little bit about it, and if someone has any specific questions, we can discuss that. The SBA rule is every loan above $350,000, if the owner owns any property, his personal residence, investment property, if he owns it 100%, it has to be pledged up to the loan amount. So it doesn't mean if someone owns $5 million of property and he's taking $1 million loan, we have to pledge all the property. It's up to the loan amount. But it doesn't mean if someone doesn't have collateral, he can't get $1 million loan. The rule is if it's available, it has to be pledged up to the loan amount. No, we would go second position. So let's just say we're going for $1 million loan. You have a house that's worth 1.5 and a $750,000 mortgage. So you have $750,000 of equity in your house. We have to put up a second on your house.
So put your house in someone else's name?
So it's something that's very tricky, and as I said, every case is different, every business is different. So it's definitely something to discuss in every scenario.
What have you seen in terms of them actually taking away a house when there's a problem?
So theoretically, let's just say the example we said before. Someone has someone has a house that's worth $1.5 million with a $750,000 mortgage, and the bank would put up $1 million on the house. What Moshe's asking is a very tricky question. because for a bank to take away their property, that means going in court. Could take up to 2-3 years, especially in New York City. And let's say they go for the foreclosure, they have to pay off the first mortgage, $750. So instead of being them out for $1 million, or maybe even less because your payments are less, I mean your outstanding balance is less when you're defaulting, they have to lay out another $750,000 and paying off the new mortgage. So they're out with a much bigger, they're out with much more money than they lent you. So as I said, they have a 75% guarantee from the SBA. So depending on the scenario, depending on what it is, it's a very tricky question.
Do you not even go near this if you're talking about small numbers? Like, you're like, this small company is 50 grand. You don't even tackle any of these. This is like only for big numbers.
So you can get an SBA loan for $10,000. Our company does not do under $100,000. It's just a very hard process to go through. So we don't do under $100,000, and I don't think it's worth going through an SBA loan under $100,000.
Okay, let's try to keep the rest of the questions to the end. Anyone else want to add something on the SBA topic?
I'd like to add what Davi was started up saying, that an SBA is not, although Davi is doing a lot 7As, which is a term loan, there are some times that a bank would give you a line of credit and cover their concerns with getting an SBA guarantee on it. So they'll do a line of credit $1 million and take an SBA, which is technically be the same requirements as a regular SBA. They're just going to take an SBA guarantee, and it's going to be a line of credit.
Yeah, it's up to $350. The line of credit is up to $350.
Okay, next topic, buying a building. Somewhat related, not always related. It may be an SBA loan of 504, or maybe you're taking the 7A and putting $0 down. When should you look to buy a building if you're paying a lot of rent, or even if you're not paying a lot of rent? You know, when we bought our building, we were wondering if it was worth tying up additional money as opposed to growing your business into a building, and we were told by someone who had been in business for a long time that every business runs through a hard time at some point. It's not an if, it's a when. And if you own a building and you own equity in the building, meaning you don't keep on borrowing against the building, when there's a rainy day, chas v'shalom, it happens one day, you may have somewhere to pull money from. And that person specifically said that it had saved him more than once. So that doesn't mean, stop running your business and running out of cash flow, go buy a building, but it is one of the side benefits that are not maybe readily apparent when people are thinking about it. Okay, who's first?
I can start. So the question, when should someone buy a building? I would say 95% of businesses should go out there and look for a building. I'll start saying how you can get to it and what the benefits are. Look at people who had businesses for 30 years. Either they retired or sold their business. If they bought their building 30 years ago, they're millionaires out there. Buildings that were worth 30 years ago, $1 million could be worth now $20 million, especially Brooklyn, even in Jersey. The real estate market in New Jersey just for the last 5 years literally doubled. Now we'll talk a little bit about the options of buying a building. First, let's discuss what a 504 loan is and what a 7A loan is. As mentioned, there are a few types of SBA loan programs out there, but the main two that we are talking about are 504 and 7A. So a 504 loan is meant and designed to buy a building. So anyone who has a business, it could be literally any type of business, can buy a building for his business with 90% financing. So the business or the borrower has to put down 10%, and he would get 90% financing for this project. Most of the times, it will either come out cheaper from your rent, or if it's a little bit more, it's still worth it instead of investing in it's worth paying another $1,000 a month, but you're paying it towards your building. We'll talk a little bit how the 504 works, and then we'll go to the 7A. If 504 works, that the borrower has to put in 10%, 50% of the project gets lent by a regular bank, like be Chase, Bank of America, or any type of bank, and the rates are usually like a regular commercial loan. The rates today are around 4.5%, and it's amortized over 25 years. The 40% gets lent by the SBA. It's not the SBA direct, it's called the CDC. It stands for Community Development Corporation. They lend 40% of the loan, and the borrower puts down 10%. And the 40% loan is amortized over 20 years, and the interest rate is like 3.7%, a very good interest rate as well. Now with a 7A loan, as mentioned, you can buy the building with no money down. Let's say you're going to buy a building for $1 million. You don't have to put down anything, and by closing, the bank would pay the $1 million to the seller, and if you're going for additional working capital on top of that, the bank would put in the money in your bank account for the additional working capital. So the answer, when someone should buy a building, we should always look out for that option and try to buy a building for your business, because you could either get it with 90% financing or 100% financing plus.
I mean, one thing I would keep in mind, just as a business owner, is buying a building does make one thing harder. It makes it harder to move. So if you're rapidly growing and you expect to run out of space very quickly, that's something to keep in mind, that if you own the building, it's not as easy to move, number one. Number two, officially, at least according to SBA rules, you have to, at least on the 504, you have to be owner-occupied. So 51% of the building, you have to be occupying. So if you were planning on moving out, renting, or buying a different building, and then renting out your building, you now have a bit of a problem. I know people have gotten away with it, but we did run into the problem where our normal bank that does our regular business did our SBA loan, so they knew everything going on, and we couldn't, just not tell them that we were moving out of the building. That would be one thing just to keep in mind on that.
Well, I was just going to say a couple other things to keep in mind when buying a building are, to Moishe's point exactly, you're losing flexibility. So let's say you're working in a part of Brooklyn that you love, or even a part of Manhattan. The idea that you can just simply buy a building if you're not doing the revenue numbers, I mean, the real estate costs in New York are extraordinary. And you have to take into consideration that you might be moving your company to a different place to be able to afford the building. There's also the aspect of you're responsible for anything that happens to that building now too. Paying rent isn't always the best, but when someone drives a forklift through your wall, it's the landlord's problem. The fire department comes in and tells you that your sprinklers aren't up to code anymore. It's the landlord's problem. There are those aspects that, if you can afford a building and the down payment on a building, or if you can do it without a down payment, the taxes that you're now going to cover, plus the yearly maintenance, as well as any type of burglaries or break-ins or anything like that, as well as now being a property owner and anyone doing anything on your property, like getting hurt, slipping, or falling. If you take all those calculations into place and it still makes sense, then buying a building is great. I think what happens is, and this happens in America with home ownership too, we race towards this idea that ownership means everything and renting is poor. And, you buy a building, you get into a 30-year mortgage and you're 6 years in and you want to do something else. Now you're either becoming a landlord or you're having to figure out how to untie yourself from a very large asset. So I think we should always think about these other real-life consequences of owning something versus the flexibility of renting.
Yeah, and just keep in mind that everybody says, they've made a fortune on their building around you if they bought 3, 4, 5, 10, 20 years ago. Doesn't mean it will continue. It may continue, it may not. Historically, eventually, prices do go up, but that doesn't mean it'll go up at the exact time you want to sell. If your building has doubled in value, yeah, it'll be pretty easy to get out of. If it's dropped, not necessarily as much.
I would like to add another thing, that some of you buy a building, there is a prepayment penalty, which is up to 5 years. Typically, you have a prepayment penalty. Take that in consideration as well. Other thing I would like to add is when you do a line of credit, one of the benefits of owning the building you're in is when a bank looks at a company to give a line of credit, they would like to see some equity. Even though it's in the building, not in the company, it's a healthy sign that a company was able to accumulate some equity in their building. And that's a reason, actually, when conventional is even better than an SBA, because in SBA, your equity level is much less. If you could afford, some of the benefits of putting down more money is that you have a stronger equity available.
Yeah, just on a side note, sprinkler issues may be your issue as a tenant. They usually are your issue, so check it before you move into the building,
Make sure you have a
especially in
good
New
lawyer.
Jersey. New York, not necessarily is particular about it. California, New Jersey, horrible. Most nets are triple net, most leases are triple net leases, so you'll be responsible for pretty much anything or almost anything. Okay, we're running out of time, so what we're going to do is we're going to cover the attractiveness topic, how to make yourself look good for the bank. We'll try to knock it out within, longest 5 minutes, and then we'll do Q&A, and if we run a little overtime, those that want to stay can stay. Okay, becoming attractive. Banks are very particular. They're generally the most risk-averse people you'll ever meet, and everybody's got to cover their own calculations and don't want to be at blame if you don't do well. So looking the part is just as important as being the part. Okay, who wants to start on that topic? Joel, you want to? DJ?
I can go first. Okay, so number one thing is just understand how banks look at a deal. So there's 5 pillars when I typically talk about bankable. It's about your length in business, how long you've been around. It's about your cash flow, if you could afford it. It's about your collateral levels. And it's also about uniqueness. Banks like to see what you are different than other companies. Like if you're only selling what everybody sells, the bank will always think, why? Who says you're going to be in business for a few years from now? You have to bring something to the table. What you're different? What's your idea? How do you get sourcing? What you're different than a different company? And the fifth thing is the thing that most people don't put they don't give a lot of emphasis to it, is about equity. And I spoke about it before. I'll just say it again. When someone takes out every penny they left in their company, whatever they earned, the bank is looking at it like, why do you want I should lend you money if you don't believe in your company to leave money over there? So equity is a very important thing. Leave over some healthy amount of equity in your company. You did a lot of money, leave some equity in the company for the years to come.
Okay. Anyone else?
An additional item that can make you attractive to the banks are let them know that by having a relationship with you, you're going to bring the entire relationship to them. So it's not just about a business loan. It's the business checking. It's your personal checking, your personal savings, maybe your investment accounts, maybe how you're going to lease a car. Whether or not you actually do those things with the bank, banks don't really make money lending money. Banks make money by having deposits. So one thing you can do that's really attractive is if you do have healthy deposits, and let's say, shop around to another bank. You don't always have to go to the bank you're currently using. By going to another bank and like showing them that you'll be bringing deposits with them, like in the case of Wells Fargo, maybe you'll even use their merchant processing. Again, they're not making a ton of money. If they make you a loan at 5% APR, that's not really where they make money. They make money by bringing in the deposits. They make money by having other accounts with you. So whether you decide to do it or not, be attractive by saying you'd be willing to bring your personal accounts over to the bank as well, because it makes you a larger financial picture for them.
I would just add a difference between an SBA loan and general line of credit. A line of credit, as Alex said, they want to keep your relationship and they want the bank with you. Versus an SBA loan, they're looking to fund the loan at one time and they want to get back their payments every month. So it's not something that they monitor every year, that you have to give them your reports and they could pull the loan for no reason, or just because they don't believe in the company. Once you get the SBA loan, you make your payments on time, you're set to go for the 10 years.
Just to finish with two small points before we go to Q&A. First of all, if you already have lines of credit or loans or whatever it is and you're doing well, you do have some leverage. So if you can get another bank to give you a better offer, go back to your bank before you jump ship and ask them to match it. And very often, if they like you, you're a good customer, they don't want to lose you, it gives them something to go back to their team and say, we need to do better for these guys because this is what they're being offered by someone else. The other thing to remember is you may get discouraged that you need money, it's hard to get, it's complicated, banks are not always the easiest to deal with. If your company is growing, you're making money, you're doing well, sooner, some way or another, you'll find a way to get the money. As long as your company is growing and you're profitable, you're not just churning money, which some people tend to do, you'll find your way of getting money. It's never been an impediment before. In some shape or form, you'll come up with an answer. Okay, Q&A. If you have a question, please raise your hand. We'll call on you, and then if you could just say the question loud enough that everyone in the room can hear, then I'll try to repeat it.
So do you generally want to give yourself leeway, or do you want to ask for the exact amount that you foresee needing, like for your holiday season coming up, like I need 100 grand for this coming season. Do I want to ask for 150 so I give myself that leeway, or assume that 6 months later, once it becomes really okay, I can always ask for more?
So let me just repeat the question in case anyone didn't hear. The question is, if you're asking for money, should you ask for the exact amount you need? Or should you give yourself a buffer so that you don't have to come running back in a few months asking for more? Is it better to have extra, or is it better not to be greedy?
I would say it starts with the cost of your capital. If your capital is cheap and you have like a really low rate, an industry term is called dry powder, like snow that hasn't been skied on. If your interest rates are cheap and the cost of capital is low, having a little dry powder so you can decide to do other things is, typically a smart move. If it's more expensive financing or financing that is meant specifically to be put to work, then you only want to take out the actual amounts you need, put that money to work, make the money that you're going to by leveraging that financing, and then come back, ideally come back at a lower rate because you've already shown a good payback history. But it really depends on the cost of the capital.
I would like to add the point. I think that in capital, they always say when you invest, you should diversify your investments. I think with capital is the same thing. I've just this week I had a client that he was using American Express corporate card. He had like $400,000, and he was always telling me, I don't need a line of credit because I have from my credit cards. They're covering whatever I need. And all of a sudden, you all know about it, they got a financial review or something, and they closed them down. And he didn't have nothing to fall on. So when you think about getting your line of credit, I typically prefer to have something like as a backup. Even on the line of credit, they could call it at any time. Even Amazon Capital, you could think, but the season will get an Amazon Capital offer, but sometimes for some reason they didn't offer you this year if your sales drop. So I would say not even you should have lines of credit available for what you need. You should have double for what you need in case of some of those you don't have access to it.
Again, if you're borrowing at 5% and you can afford it,
And I
having
think
extra money is great. If
I'm
you're
not saying
borrowing
you
at
borrow it,
15,
to have a line of credit
That doesn't
available,
cost
it
you
doesn't
money.
cost you
right,
anything.
on a line of credit's even better.
Right,
But if
line
you're
of credit is
borrowing at
something similar.
15, probably
Exactly.
not worth it.
No, I'm talking about line of credit. I wasn't
But
talking
a line,
about
of credit, a line of credit, while the cheapest, will still cost you at least
right,
LIBOR-
but you don't have to
LIBOR
use
plus
it. Just
something.
have it ready. Like if you have a credit card, just have another way in case. Don't rely on one source of capital.
Absolutely.
Yes. So, Dovi, if you could just address how many years you're allowed to be in business, what's the
Okay.
max you can borrow, top revenue
Right.
line.
No, what the range? Yeah. So basically, as mentioned, the SBA loan, and the SBA is a government program, and the bank is one who actually lends the money to the business. Now, there are a lot of SBA rules, like it's an SOP of 600 pages, and everything regarding the loan has to follow this SOP. But still, the bank is the one who lends the money, and the bank has their rules and regulations and how they feel about the business. So theoretically, the SBA says you can get an SBA loan as a startup and based on projections, but there's no banks usually that are going to give an SBA loan to start a business. Every bank likes to see at least the cash flow on the last year's tax return, so you can show at least 1 year that you show for 1 year that you can pay back the loan.
What's the maximum, though? I mean, the question was more on the other end. What's the maximum you can borrow in the business lifetime or your own lifetime from the SBA? And if you're doing X amount of profit, do you get priced out?
Right, so every U.S. citizen is entitled up to $5 million at any given time from an SBA loan, so there's no limit how many individual loans it could be. The total loan amount is at any given time up to $5 million. The interest rate usually is 2 3/4 above prime, and it's amortized over 10 years. And the criteria as mentioned before is decent credits, cash flow, and collateral depending on the loan amount.
You don't have anything to show just based on projection,
So as mentioned,
on your credit, if you have good credit.
so the banks want to see at least the last year's tax return that you have the cash flow.
Technically,
So as mentioned,
it's possible. But
it's
most banks
technically the
won't do it.
SBA has that option that if you have cash flow and projections, you can get a loan, but no bank
very
will do
rare.
that. I would say we did do in the past, if someone has a piece of real estate that's a good piece of collateral, we could probably find a bank that's going to be willing to give a loan based on a startup. But usually in normal, typical business, they want to see it.
Equity.
That's
collateral.
Right. Yeah. Yeah.
Keep in mind, it's only the SBA portion that's $5 million. So if you're buying a building on a 504, as long as the 40% that the SBA is funding is under $5 million, you're fine. So you can buy a building that's significantly more expensive than
Up to
that.
$40 million.
Any other questions? No? Okay. Oh.
You mentioned that Amazon takes on some of that risk, the fact that it's an Amazon company and anytime someone can get shut down. So across the board in terms of loans, how does that work with, I'm assuming most banks, that's why they're risk averted, they don't want to put their assets because of that. So Payoneer, if they give a $100,000 loan and you get shut down, how do they handle those loans? What's the responsibility on the lending side?
Yes. Yeah, so in terms of like a working capital or a capital advance offering, what we are doing is, if we are providing an advance to you, we are filing a UCA against your Amazon account. It's pretty standard there, just stating that if you do default on making your payments back on this advance, that we have first right to any funds that are coming from Amazon. But in the case of an advance, if you had a bank loan and you had an advance, the bank loan would have first priority. Yeah, it is. But in terms of what
They
we're
charge you
offering-
for it.
Yeah, I mean, but in terms of what we're offering, we would only offer an amount that we feel comfortable with, and it's based on a couple of factors in terms of your Amazon account being in good standing and your reviews and your returns, etc. And then also, more importantly, looking at your payout amounts and the average amount that you're doing over the last 6 months. And we generally only offer up to 1 month's payouts. That could be up to $5 million, but you basically have the sales history to back that up.
And just to add to what TJ is saying, I think a really important thing is when you're talking about a capital advance, is it's not a loan. So a loan is you making an agreement with a lending institution for you to be responsible to pay them back. When you're talking about a capital advance, that's them buying your future receivables. So a good example would be if you went to a car lot and there were 100 cars on the lot, and the person on the car lot said, all these 100 cars cost $1.5 million. And you said, well, what if I give you $1 million in cash right now? Would you sell me all the cars? And if they said yes, because they want cash in hand, that would be similar to basically buying the future sales at a discount. Now, the reality is you can't go to that car lot and drive 100 cars off in one day. So every day you're going to come to the car lot and you're going to drive 1 car off the lot. And you're going to come tomorrow and you're going to drive 1 car off the lot. In a week from now, if a tornado hits that car lot and all the rest of the cars have been wiped out and you only took 5 cars, that's your risk. You already bought all 100 of those cars. And that's why the rates kind of reflect that. Conversely, if I go to the car lot and there's barbed wire around the fence and I can't access my cars, they're my cars. I already bought them. And that's where, so like you're preventing me from taking my property that I've already purchased. And that's where what a default essentially is in a cash advance. It's you like diverting payments, changing your bank account or something similar. And I think it's something that everyone really needs to understand. The real difference between a loan and a capital advance is one is you agreeing to pay me back, and the other is I've already bought it, and it's my responsibility to now collect it under whatever prescribed terms we've agreed to.
In other words, they've bought the money that Amazon owes you. Right. So it no longer belongs to you, it belongs to them.
Well, more importantly, we've bought the money that you are going to make in a future time from Amazon.
If you're going even further.
And then they just take it out slowly from your payments.
Right.
At least with C2FO, they get paid directly from Amazon. Amazon gives them the money straight up. You never even see it afterwards. You had a question?
Yeah. How does a bank look at a business that is not showing a profit instead of 2017 and 2018? But in 2019 financials are showing a healthy margin, and their DSCR will be there. But they haven't filed taxes yet. This is beginning of 2020 now. Who's filed? So how does the bank analyze the business?
In other words, what are preliminary numbers worth?
So it's hard to say. Some banks will, again, it must be a very strong company and a good explanation why they didn't have any profits in the previous years. They should be strong enough by reports. And the number one thing is it's a topic that I was prepared talking about is about having proper reporting. And sometimes I see a lot of Amazon sellers, they have they use an accountant, a friend or family member, and as they grow, they don't realize it's time for them to outgrow that. You have to go to a better accountant. If you have a good accounting firm with audited financials, sometimes it could be acceptable even if the tax returns are not filed yet.
Dovi?
Yeah, I would add to this that, so you're saying you're holding now February of 2020 and you have reports as of December 31st. If this is the numbers that you're going to file, just put it in a draft tax return and let's propose that for the bank. And before closing the loan, you're going to go and file that tax return. So if that's the real numbers, just put it in the tax return and we'll get it done based on that. Because financials, everybody could just create financials, and as a lot of people saw, you can show you made $500,000 on the financials, but then when it comes to tax returns,
that's what I'm saying. It depends on the quality. If you get from a good firm and it's audited or reviewed,
even though if it's certified financial, certified accountant financial, maybe that's considered as tax returns. But just instead of paying your accountant to do certified accountant financials, just put it in the tax return. So if that's the real numbers, just put it in the tax return and we'll go with that.
Okay, everyone, we're out of time. Thank you very much. I'm sure the panel is here without asking their permission, but if you have any additional questions, I'm sure you can come up to them and they'll do their best to help you. Thank you, everyone.
Thanks, everyone.
Thank you, Moshe.
Thank you.